Why 1% risk changed my trading forever. Most traders do not lose because they lack strategy. They lose because they do not understand risk. That is the uncomfortable truth many people avoid. A beginner can spend months learning chart patterns, indicators, supply and demand zones, market structure, liquidity concepts, and still destroy an account in a single week. Not because the strategy failed, but because the trader failed to control exposure. The market does not care how confident you feel. It does not reward excitement. It does not protect impatience. And it certainly does not forgive oversized risk. One bad trade with poor position sizing can erase months of disciplined work. That is why professional traders think differently. Beginners focus on how much they can make. Professionals focus on how much they can survive. There is a massive psychological shift that happens when a trader finally understands this. For many traders, that shift begins with something simple. 1% risk, not 5%, not 10%, not "this setup looks too good to miss." Just 1%. Simple, boring, slow, but life-changing. Because the moment you truly respect risk, your entire relationship with trading changes. You stop trying to get rich quickly. You stop revenge trading. You stop emotionally attaching yourself to single outcomes. You stop seeing trading as gambling, and you finally begin thinking like someone who intends to stay in the game for years. In this video, we are going to break down why risking only 1% per trade completely changed trading performance for many serious traders. We will discuss why most traders blow accounts despite having decent strategies. The dangerous psychology behind oversized risk. The difference between beginner and professional risk behavior. How drawdowns silently destroy traders. Why capital protection matters more than fast profits. Practical examples of position sizing and risk management. And the one rule every trader must follow if they want longevity. This is not motivational trading content. This is not hype. This is the reality professional traders eventually learn. And usually they learn it after losing money first. So, if you are serious about trading survival, consistency, and protecting your capital, stay focused. Because this conversation might save your account. Section 1. The biggest lie beginners believe. Most beginners enter trading with the wrong expectation. They believe the goal is to make money quickly. That belief alone creates dangerous behavior. The trader opens a small account, maybe $100, maybe $500, maybe $1,000, then immediately starts calculating unrealistic returns. How can I turn this into 10,000 quickly? That question sounds harmless, but it is the beginning of emotional trading. Because once speed becomes the goal, risk naturally increases. The trader starts forcing opportunities. Lot sizes become larger. Stop losses become wider. Risk management disappears. Every trade suddenly feels important. Every setup becomes high probability. And the account slowly enters a dangerous cycle. Small wins create false confidence. Then one large loss wipes out everything. This is how many trading journeys begin. Not with discipline, with impatience. The beginner thinks, if I risk more, I make more. Technically, that is true, but what they fail to understand is this. The bigger the risk, the smaller the margin for error. And trading is a game of uncertainty. No setup is guaranteed. No strategy wins forever. Even profitable systems experience losing streaks. That is normal. But beginners behave as if losing streaks only happen to other people. So they overexpose themselves. Then reality arrives. A trader risking 10% per trade only needs a few losses to create severe damage. Let us think practically. Imagine a trader has a $1,000 account. They risk 10% per trade. That means every loss costs $100. 4 consecutive losses equals minus $400. Now, the account is down 40%, and this is where psychology starts collapsing. The trader becomes emotional. Fear increases. Pressure increases. Now every trade feels like recovery. not execution. The trader stops following the plan. Maybe they revenge trade. Maybe they double the lot size. Maybe they remove stop losses entirely, and usually the account destruction becomes faster from there. This is why many traders never survive long enough to become skilled. Their risk kills them before their experience can grow. Why 1% risk changes your psychology? 1% risk sounds small, almost too small, and that is exactly why many beginners reject it. They think, how can I grow my account risking only 1%? That question reveals the real issue. Most people enter trading obsessed with speed. Professionals become obsessed with stability. Those are completely different mindsets. When you risk only 1% per trade, several psychological changes begin happening. First, fear reduces. A single loss no longer feels catastrophic. You stop staring at every candle emotionally. You stop panicking during small pullbacks. You stop interfering with trades unnecessarily because deep down, you know one loss cannot destroy you. That emotional stability matters more than people realize. Many traders are not losing because their strategy is terrible. They are losing because their emotions keep sabotaging execution. Risk too much and emotions become uncontrollable. Risk less and discipline becomes easier. Second, patience improves. When traders over-risk, they crave constant action. They need frequent wins to maintain emotional comfort. That creates overtrading. But when risk remains controlled, there is less pressure. You can wait. You can ignore mediocre setups. You can think clearly. Third, consistency becomes possible. This is important. Professional trading is not about explosive profits. It is about stable execution over long periods. A trader who survives for years has a greater chance of success than someone chasing fast money for 2 months. 1% risk supports long-term consistency. Because even during difficult periods, the damage remains manageable. Imagine losing 10 trades in a row. That sounds terrible emotionally. But mathematically, risking 1% per trade creates a completely different outcome. A 10-loss streak does not destroy the account. Painful? Yes. Fatal? No. Now compare that to someone risking 10% per trade. That trader enters emotional crisis long before 10 losses arrive. The difference is not just mathematical, it is psychological. The smaller the risk, the clearer the mind. And clear thinking matters in trading. Because the market constantly tests emotional weakness, fear, greed, impatience, ego, revenge, overconfidence. All of these become amplified when risk is too high. Many traders think risk management limits profits. In reality, proper risk management protects decision-making, and good decisions create long-term profitability. 1% risk creates emotional breathing room. That breathing room allows discipline to grow, and discipline is what separates surviving traders from gamblers. Beginner versus professional mindset. There is a clear difference between how beginners and professionals think about trading. Beginners ask, how much can I make? Professionals ask, how much can I afford to lose? That single difference changes behavior entirely. A beginner sees a strong setup and becomes emotionally attached. They increase risk aggressively. They think, this trade will change everything. A professional sees the same setup differently. They understand probabilities. They know even strong setups can fail, so they remain calm. They execute according to plan. No excitement, no desperation, just controlled execution. Beginners often believe confidence means increasing lot size. Professionals know confidence means following rules consistently. Beginners focus on individual trades. Professionals focus on series of trades. This is critical. A professional trader does not emotionally depend on one setup. They understand trading outcomes work across large samples. One trade means very little. 20 trades matter more. 50 trades matter more. 100 trades reveal the true quality of execution. But beginners struggle to think this way. Why? Because emotional attachment narrows perspective. When a trader risks too much, every trade feels personal. The outcome suddenly affects confidence, identity, and emotional stability. That pressure creates irrational decisions. Professionals reduce this emotional intensity through controlled risk. 1% risk keeps the mind balanced. Even after losses, professionals remain functional. That emotional neutrality is extremely valuable. Another major difference is how each group views drawdowns. Beginners see drawdowns as temporary inconvenience. Professionals see drawdowns as serious business, because recovering from large losses becomes increasingly difficult. For example, if you lose 10% on an account, you need roughly 11% to recover. Manageable. But if you lose 50%, you need 100% growth just to return to break even. That is enormous pressure. Large drawdowns create psychological damage alongside mathematical damage. Confidence drops. Execution quality drops. Decision-making weakens. The silent danger of drawdowns. Most traders underestimate drawdowns. They focus heavily on profit potential, but they rarely calculate the consequences of losing. That is dangerous. Drawdowns are not just numbers on a screen. They affect psychology deeply. Every trader believes they can handle losses until the losses actually happen. Then emotions appear. Doubt appears. Fear appears. Anger appears. And sometimes desperation appears. This is where trading behavior becomes unstable. Imagine a trader loses 30% of their account. Now they feel pressure. The desire to recover quickly becomes intense. Suddenly, patience disappears. Risk increases. Setups become forced. Discipline weakens. The trader enters survival mode emotionally. This is how drawdowns become account-ending events. Not only because of the money lost, but because of the emotional instability created afterward. Professionals understand this. That is why they protect against severe drawdowns aggressively. And 1% risk helps reduce this danger significantly. Position sizing, the skill most traders ignore. Many traders think position sizing is boring. That is usually because they do not understand its importance. But position sizing is one of the foundations of professional trading. Without it, emotions dominate. Without it, consistency disappears. Without it, survival becomes difficult. Position sizing simply means controlling how much money is exposed on each trade. Not based on emotion, not based on excitement, not based on confidence, based on predefined risk. This is where 1% risk becomes powerful. Instead of randomly increasing lot sizes, the trader builds structure. For example, if a trader has a $10,000 account and risks 1%, the maximum acceptable loss per trade becomes $100. That number remains fixed regardless of emotions. Now, the trader calculates position size according to stop-loss distance. This creates consistency. It also removes emotional guesswork. Beginners often do the opposite. They choose lot size first, then place stop-losses carelessly. Or worse, they avoid stop-losses entirely. That behavior turns trading into gambling. Professionals think differently. They define acceptable risk before entering the market. The trade must fit the risk model, not the other way around. Why survival matters more than profit. This is one of the hardest lessons traders learn, especially beginners, because everyone enters trading thinking about money, freedom, lifestyle, fast growth, large profits. But the market teaches a different lesson. Before profit comes survival. Because without survival, profit becomes irrelevant. Imagine two traders. One trader makes 40% in a month but blows the account 3 months later. Another trader makes 4% monthly consistently for years. Who actually succeeds? The answer becomes obvious over time. Longevity matters, consistency matters, capital preservation matters. The trading industry often glorifies aggressive returns. People love posting huge percentage gains, but what they rarely show is sustainability. How many of those traders still remain profitable after 2 years? How many survive multiple market conditions? How many avoid emotional collapse during drawdowns? Professional trading is less glamorous than social media presents. It is repetitive, structured, controlled, sometimes boring. But boring behavior often creates stable results, and stability is valuable. The rule. Every trader must follow. If there is one rule every trader must understand, it is this. Never risk so much on one trade that emotions control your decisions. That is the rule. Simple, but extremely important. The moment your risk becomes emotionally uncomfortable, discipline begins weakening. Fear increases. Greed increases. Patience disappears. Objectivity disappears, and emotional trading starts. Professional trading requires emotional control, but emotional control becomes difficult when exposure becomes excessive. If these does, you make sure to share this video, hit the like button, leave a comment below, and don't forget to subscribe to the channel. The Trading Jagaban. Watch this next.